Welcome, CFA candidates. Today, we'll explore the world of fixed income, a vital part of the CFA Level 2 curriculum. Fixed income focuses on understanding bonds, interest rates, and credit analysis concepts essential for building portfolios, managing risk, and evaluating investments. This essay will walk you through key topics that require minimal mathematical computation while offering rich insights into the mechanics of the bond market. So, let's dive into the fascinating world of fixed income. 1. Understanding yield curves and interest rate dynamics. Let's start with yield curves, a foundational concept in fixed income. The yield curve is a graphical representation of the relationship between bond yields and maturities. Imagine a curve that shows short-term interest rates on one end and long-term rates on the other. The curve's shape can be upward sloping, flat, or even inverted, each shape revealing important economic signals. An upward sloping curve is the most common and indicates economic growth, as investors demand higher returns for lending money over a longer period. A flat curve often signals uncertainty, while an inverted curve suggests a potential recession, as short-term rates exceed long-term ones. These dynamics are critical for bond pricing and investment decisions. Now, let's talk about how interest rates affect bond prices. Bonds and interest rates have an inverse relationship. When rates rise, bond prices fall because newer bonds offer higher yields, making older ones less attractive. Conversely, when rates drop, bond prices increase, as their fixed payments become more valuable in a low-rate environment. 2. Credit risk and credit ratings. Moving on to credit risk, the risk that a bond issuer might default on payments. Credit risk is central to bond analysis, as it determines how much compensation an investor should demand for bearing the risk of non-payment. Credit ratings, assigned by agencies like Moody's, S&P, and Fitch, provide a quick snapshot of a bond's creditworthiness. Bonds rated AAA are considered the safest, while bonds rated below BBB are classified as high-yield or junk bonds. These ratings influence bond yields, as higher risk demands higher compensation. Investors also analyze credit spreads, which represent the difference in yield between a corporate bond and a risk-free government bond. Wider spreads indicate higher perceived risk, while narrower spreads suggest confidence in the issuer. By monitoring these spreads, investors can gauge market sentiment and adjust portfolios accordingly. 3. Securitization and asset-backed securities. Now, let's talk about securitization, an innovation that has transformed the bond market. Securitization pools various financial assets, like mortgages or car loans, and repackages them into bonds called asset-backed securities, or ABS. Here's how it works. Imagine a bank that issues home loans. Instead of waiting years to recover the loan payments, the bank pools the loans and sells them to investors as securities. These securities are structured into tranches, with senior tranches having the least risk but lower returns, and junior tranches bearing higher risk for potentially greater rewards. Mortgage-backed securities, or MBS, are a well-known type of ABS. They played a central role in the 2008 financial crisis, highlighting the importance of understanding the underlying assets and risks. Another type is collateralized mortgage obligations, or CMOS, which use cash flow prioritization to meet different investor needs. Securitization adds liquidity to markets by allowing banks to free up capital and make more loans. However, it also introduces complexity, as investors must assess not only the securities, but also the quality of the underlying assets. 4. Theories of term structure. Next, let's explore theories of term structure, which explain why yield curves take different shapes. The expectations theory suggests that long-term rates are an average of current and expected short-term rates. For instance, if investors believe rates will rise, long-term yields might be higher. The liquidity preference theory argues that investors demand a premium for holding longer-term bonds due to the uncertainty and risk of locking up their money for extended periods. Finally, the market segmentation theory posits that investors and borrowers have specific maturity preferences, influencing supply and demand at different points on the yield curve. Understanding these theories helps investors predict interest rate movements and align their strategies with market conditions. 5. Bonds with embedded options. Embedded options add complexity to bonds by giving issuers or investors additional rights. Callable bonds allow issuers to repay the debt early, often during periods of declining interest rates. This benefits the issuer, but introduces reinvestment risk for the investor. Putable bonds, on the other hand, allow investors to sell the bond back to the issuer before maturity, offering protection in rising rate environments. Convertible bonds give investors the right to convert bonds into equity, combining features of debt and equity investments. These options impact bond pricing and risk. For example, callable bonds typically offer higher yields to compensate investors for the risk of early redemption. Understanding these features is critical for valuing and managing fixed income portfolios. 6. Risk management in fixed income. Managing risk is central to fixed income investing. The two primary risks are interest rate risk and credit risk. Interest rate risk arises from changes in market interest rates. Duration, a measure of a bond's sensitivity to rate changes, helps investors manage this risk. For example, a bond with higher duration will experience larger price swings for a given change in interest rates. Credit risk, as discussed earlier, focuses on the issuer's ability to meet obligations. Investors use credit spreads and ratings to gauge this risk. Hedging strategies, like using interest rate swaps or credit default swaps, can mitigate these risks by transferring them to other market participants. 7. Inflation-linked bonds. Inflation-linked bonds, like Treasury inflation-protected securities, TIPS, offer protection against inflation. These bonds adjust their principal value based on changes in inflation, ensuring that the purchasing power of returns remains intact. For instance, if inflation rises, the bond's principal increases, resulting in higher interest payments. Break-even inflation rates, derived from comparing nominal and inflation-linked bond yields, provide a market-based measure of expected inflation. This insight helps investors decide between nominal bonds and inflation-linked securities. 8. Structured products and CDOs. Structured products like collateralized debt obligations, or CDOs, are another innovation in fixed income. CDOs pool various debt instruments, such as loans or bonds, and divide them into tranches based on risk and return profiles. Investors in senior tranches receive lower returns but enjoy greater protection from default, while those in junior tranches face higher risk for potentially higher rewards. Structured products offer tailored solutions for different risk appetites, but require thorough analysis to understand their complexities and risks. 9. Global fixed income markets. The global fixed income market offers diverse opportunities, from developed government bonds to emerging market debt. Each market presents unique risks, such as currency fluctuations, political instability, or differing regulations. Currency risk is a major consideration for international bonds. Investors must evaluate how exchange rate changes might impact returns. Hedging strategies like currency forwards or options can protect against unfavorable movements. 10. Fixed income portfolio management. Finally, let's discuss fixed income portfolio management. Passive strategies, like indexing, aim to replicate a benchmark, while active strategies seek to outperform through security selection and duration adjustments. Liability-driven investing, or LDI, focuses on matching bond investments with future liabilities. For example, pension funds often use LDI to ensure they can meet obligations to retirees. Other strategies, like horizon matching and cash flow matching, help align bond portfolios with specific financial goals. Conclusion: fixed income is a diverse and dynamic field, offering opportunities for stable income, risk management, and portfolio diversification. By understanding yield curves, credit risk, securitization, and global markets, CFA Level 2 candidates can master this important section and apply it to real-world finance. Thanks for listening, and good luck with your studies.